A soft drink maker, and a REIT are a couple of growth and income opportunities that our growth and income strategist Todd Bunton wants you to know about. And he's here with me now. So the soda maker is Dr. Pepper.
Yeah, Dr. Pepper Snapple Group is their name. DPS is their ticker symbol.
Yeah.
The third largest soft drink company in the U.S. I'm sure everybody can name the other two. But it's interesting. They actually have a nice niche inside of the non-cola carbonated soft drink market, with 6 of the top 10 brands, including 7-Up, A&W, Sunkist, Crush. They have Hawaiian Punch. About 40% market share in that market. So, and of course, obviously, they have the Dr. Pepper and Snapple brands. They're flagship brands that we all know about.
Right.
But the company has delivered 4 consecutive positive earnings surprises, and sales have actually been fairly flat, just slightly positive, kind of low single-digit growth. But their profit margins have been expanding, and that's been driven by lower commodity costs and productivity enhancements, and that's led to double-digit increases in earnings. And if you take a look, consensus estimates have moved steadily higher over the last several months as the company's delivered those 4 consecutive earnings surprises. Sent it to a Zacks rank of 2, which is a buy rating. And if you look at consensus estimates, analysts are expecting about 11% earnings growth this year and 6% growth next year. Now, to go along with that growth, they pay a dividend that yields 2.6%, very solid dividend. They've actually increased that at a 13% compound annual rate over the last 4 years. And the company generates solid, stable cash flows, just like Coke and Pepsi, the other soft drink makers do. Solid profit margins, high returns on invested capital, and pretty solid balance sheet too. So I'd expect that dividend to continue growing over the future. In addition to that, they trade about 17 times forward earnings. That is a discount to the industry median of 19 times. So a little bit of relative value there, not super cheap, but definitely reasonable valuation to go along with good growth and income metrics. I would expect solid total return potential from this name over the next 6 months.
All right. The next selection, Chatham Lodging Trust, CLDT, the ticker symbol. This is the REIT.
Yeah, they're a real estate investment trust focused on hotels and primarily upscale extended stay hotels and also select service premium branded hotels. They own or have an ownership interest in 77 hotels in 15 states and D.C.
Wow. And
yeah, they've been growing. They've been acquiring and growing. It's still a small cap stock though, a market cap of just under 600 million. So, one of the smaller names out there, but the company has benefited from favorable hotel industry trends. You're seeing a solid rise in occupancy rates across the industry this year, and also higher room rates. And if you think about a hotel, they're really highly leveraged in terms of operating expenses. So they have a high degree of fixed expenses. So any incremental increase in revenue falls, pretty much to the bottom line and can drive huge earnings growth. And that's what we've seen this year through with Chatham Lodging Trust. The company recently delivered a very solid second quarter beat. They saw the increase in occupancy rate, they saw the increase in room rates, and they're seeing profit margins expand as you'd expect. And management actually increased its guidance after the last beat, prompted analysts to revise their estimates higher, sent it to a Zacks rank of 2. I also brought with me the price of consensus chart, and you can see a huge increase in consensus estimates over the last several months. It's a number 2 rank, which is buy rating right now. Based on those consensus estimates, analysts are expecting 30% funds from operation growth this year and 24% growth next year. So good growth story going on here. Obviously a very good income story as well. REITs have to pay out at least 90% of their earnings in the form of dividends to avoid paying tax on that money. So you're getting a 4.4% yield to go along with the growth here. And the valuation looks reasonable too. They trade at less than 10 times forward funds from operation. The industry median is 15 times, so there's some value to go along with the good growth and income metrics here. One caveat is REITs in general have high interest rate risks. So as interest rates rise, that dividend yield looks less expensive or looks less attractive. They also have a lot of debt, as you can imagine. So they do have a lot of interest costs on their income statement. So that is one thing to look at, to be cognizant of. But if interest rates at least hold steady over the next several months, which I'd expect them to, if you look at longer-term U.S. rates, they're comparable to rates in Europe, actually pretty attractive, I would say. So that could keep a lid on interest rates going forward and could provide a nice tailwind to CLDT.
All right. Do you own either of these two?
I do not.
All right. If you're not over at Zacks.com, our website, Get on over and check out more stock picks and stock picking strategies for your consideration. With Todd, I'm Terry Ruffalo.